Alright guys, so I hope you're doing fine as always. Today I'm making another quick video about the concept of market makers, as in my opinion this is very important to understand before we can move to the vector candles themselves. So by definition, market makers are individuals or firms that facilitate trading in financial markets by providing liquidity. They do so by standing ready to buy and sell securities such as stocks, cryptocurrencies, or normal currencies, at publicly quoted prices. Essentially, market makers act as an intermediary between buyers and sellers, ensuring that there is a smooth flow of trading activity. So this is just the definition. If we now look in how they operate, we can split this in four different parts. First of all, liquidity provision. So market makers quote both a buy and a sell price for a financial instrument. This can be stocks, crypto, normal currencies, and so on. They provide liquidity by willing to buy securities from sellers at the bid price and sell securities to buyers at the ask price. This ensures that there's always a counterparty to trade. So it's really important to understand that markets are a zero-sum game. Whenever you buy, someone is selling, and whenever you sell, someone is buying. And this counterparty is often the market makers. Secondly is maintaining orderly markets. Market makers play a crucial role in maintaining orderly markets by narrowing the bid and the ask spread. So they prevent huge gaps appearing between the bids and the asks. And third, we have the risk management. So for market makers, it's really important to have a good risk management. Market makers will manage their securities or their assets with an associated risk. So they use various strategies to hedge their positions, such as buying or selling related securities or derivatives. And their final goal of this all is, of course, to profit. They have to generate profits. Market makers have different ways of profiting of the markets. For example, they can profit out of the bid and the ask spread, etc. Or on the future markets, they will hedge their positions with spot holdings. So in summary, market makers play a vital role in financial markets by providing liquidity, maintaining orderly trading conditions, and facilitating price discovery. Their activities help ensure that markets function smoothly and efficiently. It's really important to know that without the market makers, it would be impossible for us retail to trade actively. But what's the impact of the market makers on the markets? So again, it's really important to know that market makers are not a charity. Their job is to provide liquidity, and at the end of the day, they want to generate profits. So it's good to know that market makers will limit their risks as much as possible. So they will, for example, hedge their future positions with spot holdings, which then gives them the opportunity to guide or mark the price of the markets in any direction they want. So we can summarize the market maker's activity simply in three different points. First of all, it's searching for stop losses and liquidity points in the market. So market makers will in general mark the price to points or areas in the market where a lot of retail traders, in some cases also institutions, have their stop losses or their liquidation points. They want these areas to be hit in order to create more liquidity out of the stop losses or the liquidations of these retail traders. By doing so, they will build their long or their short positions while providing liquidity. So an example, if the price is going up aggressively, the retail will be buying, 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 while market makers has to go either selling on spot or they in the future markets they have to go short. So they're building up short positions when price is going up. So eventually they have to mark price all the way back down into these short positions in order to close them and to finish their books. So while providing liquidity, they will also build up these short positions. And I already mentioned the last point. So whenever they build up these longs and short positions, eventually they have to go close them. So they have to reverse price and mark it back down all the way while opening or closing their previously opened long and short positions. So while they mark price the other way, they're also again opening new positions against the trend. But on this topic we will go in further on the vector candle video. So finally I want to show this image that I found on DGG that sums up the difference between a normal trader as you and I and a market maker. Keep in mind this is mainly based for spot holdings. So feel free to take a screenshot of this image and inspect it, but this is pretty much all set during the video. Maybe in different words, but still. So as always, guys, if there's any questions, please feel free to post it in the Discord or write it in the comments, and I'll see you guys in the next video. Take care, guys. Bye-bye.